Right. So, so right now, we were talking, at least for the last year and a half, that crypto is not an investment. It is all speculation. It seems to be a Ponzi scheme, and whoever pays, there's one person that starts it and types it, and whoever in this, what seems like this exchange, the FTX turned out to be a, they were doing illegal things. They were using customers' deposits for investing, and there's basically going to be regulation after this, it seems. But one thing that I've heard from some analysts are there are some well-capitalized companies such as Coinbase that they have a lot of money, and they could benefit from some kind of regulation. I don't know. It's outside the realm of. So I mean, Coin. Kathy from the ARC series is buying it like nuts, even when it's going down. And it could be just that they've become, the leader in this, and they have all the market share. But I don't know. It's just so speculative. It's outside of my realm of understanding.
Yeah, and so I think that's I think that's not a bad idea here, is that, we understand why New York and London and, like Tokyo, why these certain stock exchanges, why finance moves there, Frankfurt, is because there's trust and regulation, and that I think we could see that happening in the crypto markets, that, Gemini or Coinbase or places that, they're maybe not the biggest exchanges right now, but they're in well-regulated places, and there's trust that that those would be places that in the future, as confidence is lost in these exchanges located in the Bahamas or nowhere, there might be people will flee that. I think that's a valid thesis.
Right. All right. So let's. I'll go over that a little bit later on. First thing I wanted to show everyone, a quick. It's called Market Watch screen of the most shorted stocks in the stock market and what they're up today. In one day. You can see that there's a high correlation right now. That I think we were talking about it for a couple of weeks. Whenever there's a bear market like we've been having, let's look at the stochastics for the S&P. This is as of last night. You can see we're in a lower highs, lower lows environment. We're at the absolute top of this channel right around right now. And we had a run in all of these stocks that are heavily shorted. What happens, in market bear market rallies is you have people thinking shorting in a major way, and whenever a thesis for that bear position switches, then you have a covering of shorts, and you have a passive rally. But you have to keep in mind, though, that we still are in this channel as of this morning. We're still, and that's why we're kind of going back and forth between losses and gains in this indexes today, is we have to break out of this downward channel, or we're going to be going back down. But the one of the main thesis of, we were talking about home builder stocks for a while, and we were saying how undervalued those home building stocks, Home Depot, anything home related. What happened, whenever the CPI came out on Thursday, we were saying that is a catalyst. It could be a good or a bad catalyst, and it wasn't as bad as feared, and it was actually better than most people expected. So what happened was mortgage rates went down 0.5% lower than the day before. And when we had that could have been that switch. I was expecting, interest rates, whenever the Fed starts reducing rates, that would help the home builders. But it turns out once they stop going up, maybe that is, and all the home builders went up 12, 15% yesterday. So, so the bear thesis for these home builder stocks is as interest rates go up, it makes houses less affordable, and then they won't be able to charge as much for houses, and their profitability will go down, less demand. But we have, for each one of these shorted stocks, we had the people that were shorting, for the most part, covering their positions, and that even happened until today. A lot of these are stocks that are down 80% already, but they have, each one of these has themes, like the Carvana. They had a $1 target, on them, from one of the brokerage companies. They had declining used auto price sale cost. You see what else? Another Upstart was one of the ones that was up to $500 a share last year. We were talking about, didn't have all those numbers that we were looking for, but it was heavily shorted, down 84% year to date. Look at all these year to date. But what it seemed like is we had a short covering rally, but you have to keep it in context to where we are in the stock market. So it's like a bear market rally right here, it seems. Now, if we have a little follow through, and we see in our stochastics that some of our downward trends are starting to be broken out of. Let's look at almost every one of the indexes are still in that trading range. I'm looking at right here. You see the technology, QQQs, consumer discretionary. Materials are right at the top of their channel. So nothing has really changed in our themes right now. We're still, for our dividend stocks, we're still going sideways. For our growth stocks, they're still in a downward channel. But perhaps, a inflation break where we're not going up as much, or we're not going up anymore, maybe that's what the market needs. So we can see that the XLF, we're starting to break out of that downward channel. And we know that financials do better whenever interest rates go up. So I'm just surprised that, well, we'll see. XLU, it's a dividend stock. It's still in this channel. We're starting to break out of the real estate ETF. See if anything ever happens to that. XLE, it's still on an uptrend. You see. Okay, so looking at all of our stocks, we can see Abbott is starting to break out of this downward trend. What other stocks are interesting to note? Okay, CSX, it's the top of its range. A lot of the stocks that we're following are at the top of the So we're like a crossroads right now in the stock market. We're like, whenever you look at the Yahoo Finance, let's look at the Yahoo Finance right now. Okay, so we have, it's like a mixed market, they call it. Whenever you're looking at the market in general, there are patterns. As you can see, the Dow is making lower highs, lower lows. NASDAQ is making higher highs, higher lows. So usually the indexes follow these patterns for the rest of the day when they start that way. Let's look at what the S&P. So we have like this. The whole market knows we're at the top of this channel, higher highs, right? And almost every stock is this point of either going back down to lower lows, or breaking out. We don't know which way it's going to go. We still have, some leaders that we're following. The Pepsi, they're able to raise their prices and increase their earnings estimates. Starbucks is continuing to go up, and Visa is at the top of its trading range right now. So this is a inflection point. We had some good news, but it wasn't. I don't think it was that great news. All right, so we can see Amgen kind of breaking out of its range. So those are like little tips we have right now. eBay started to break out of its downward channel, and all right, that's all we have right now for stochastics. Okay, so what we have is a short covering rally back up to, we were talking about this $400 range as the top of the S&P 500. So let's look at, we've been making higher highs, higher lows in this little uptrend. Now we're at the top of this. Look at our calendar. We look at our calendar and we see Thanksgiving is coming up in 2 weeks. Not next week. Not next week, the week after. So usually the market's pretty good then. We're overbought right now. So you can see we're at 75. Okay, so people are excited. They're greedy. Volatility is going down. So we have a situation where everyone's excited. It's just at that time, the market will do the opposite of what you think it will. I'm fully invested, and I'm expecting the last 2 months of the year to be good. Let me see. And it seems like we could have a rally if we break out of this. We break out of this downward lower highs, lower lows. This is today we're doing this. If we break out of this downward trend, that could make. Whoa! I don't know what I did there. I broke it out. Okay. I don't know how this happened. Okay. So if we break out of this, that means we're going to be rallying pretty much through the Fed meeting. The Fed meeting is on the 14th. They'll give us a hint if they're done or not. They'll say we've either achieved our terminal rate, we're not going to raise anymore, and that could be a huge, rally, reason to rally for the rest of the year. And let me see. Otherwise, we could. Right now we're overbought, so we could consolidate at least for the next week or so. All right, that's the big picture. Any questions on that? All right. So we always go over this checklist because every week we have reasons for the stock market to go up and down. The Treasury, 10-year and 2-year are down 8% each as of this morning. So that is really good for the stock market going up because that means the Fed will not be as much in the interest rates. And so we had a lot of positive catalysts for the stock market going up. We had a inflation reading on Thursday that was better than expected. That's probably the best thing. We have Russia is actually retreating, and there's talks and negotiations. China is starting to say to Russia that you better stop this war, and nuclear. If anything happens nuclear, you're going to lose us as a trading partner, which they can't afford. So that's really good. And there was an election too on Tuesday. Elections, our rules are Republicans are business friendly, Democrats are people friendly. So Democrats, right now, one of the biggest problems for the stock market, we don't know who's going to be controlling the House, the Republicans or the Democrats. So right now it looks like Republicans have an advantage, which is really good for the stock market. So, but we have a runoff. We have a couple other undecided, uncounted votes. So all this is affecting. The uncertainty in the stock market. If we had a lot of these lining up, we would would have a tendency of rallying a lot more. So, hit up for a second. All right. So, okay, just start talking to us. Other big things. China reduced the quarantine time to 2 days, so they're starting to relax their COVID policy. That was one of our main talking points. If China COVID lockdown ends, then all these overseas growth, like from Nike to Apple to a lot of companies that sell their products overseas, Starbucks, they're all going to be helped by and all the China stocks, of course. They're all going to be helped, and that'll help the manufacturing of goods that are made in China from American companies. So another good thing. These are all really, really positive. Dollar is down 3% this week. So our formula is dollar goes down, or multinationals like Google, Apple, their profits will be higher. So there could be a tailwind for companies that do business overseas. If the dollar goes down, then there's more profits for multinational companies. And inflation is getting better. From this Thursday's meeting, it's what's happening is they're measuring year-to-year increases in prices, and as we progress, year-to-year comparisons are going to look better because it was high inflation last time this year. So every month we go, it'll be a better comparison because there was in December of last year and January of this year. So, but that's in our favor too. That number will be getting better, and we're currently overbought, so that's not so good. Although we know from the rally in the S&P at the COVID time, we were overbought for months. Let's go back to that time. Whenever we were down here, this is very similar to where we are right now. We were overbought. We didn't really go to oversold for a while. We didn't get to oversold until the middle of September. So we don't know how long it's going to be. Going. We don't know how long it's going to be overbought. But whenever you have short squeezes going on, when you have a fear of missing out, and you have a lot of these things falling in line for our, will the stock market go up? Then you would have a tendency to keep going up. So, So I changed this last note here. Okay. The last note is. Okay. The last note is we're changing from raising stocks that do good in rising interest rates to stocks that do good in an interest rate environment where we're kind of unchanged to going. We know there's going to be maybe one more interest rate hike, but interest rates are peaking and maybe flatlining for a year or so. But in that environment, what do you do? So we changed that. We're looking for a low PEG ratio stocks that for our growth part of our portfolio, ones that have been sold off with everything else that have great valuation, low PEG ratios, and predictable safe business models. And we're looking at right now. There's a lot of high yielding stocks like the dividend aristocrats, stocks that continuously increase their dividends over time. A lot of them are down 40%. And this could be a time to start looking for the income part of your portfolio, because right now, if the rates are plateauing, maybe going up another point or so, you might want to start looking into, if you don't have any, it's the income part of your portfolio. You see. And the last thing to think about are, let's go back and look at this, most shorted stocks in MarketWatch. There are some stocks here that might have, a really large total addressable market. Anything that had a good story last year went up 100%. Now all those stocks that don't have earnings, that still have a potential total addressable market that's really big, they've been sold off 90%. And so this could be a time when you start looking at investing in stocks that perhaps have the criteria that Kathy Woods would like, and see if it makes any sense. We know that there's going to be a rollout of electrical vehicle charging stations around the world. I mean, the United States, with some new funding from the government. So we know that's going to happen. All those stocks are heavily shorted right now because they're not making money, but potentially that could be the kind of a stock that has a very high total addressable market that is still down a lot. But you wouldn't want to put a lot into those right now, because you have the dollar cost a very small amount at a time, and because the stocks that don't have earnings are sold off a lot in this environment, and they're not as reliable as the other stocks we're following. Okay, any questions on any of that? Right. So oil has not changed since last week. The big story is the 2-year, 10-year are down 8%. That was from that I think it's a CPI reading on Thursday. And you see, inflation in that report is around 7.7% year over year, and the dollar is down 3%. That is a tailwind for every stock doing business overseas. All right, so let's look at the sector ETFs. Just what would do best today? Home builders? Let's look. Oil. That's interesting. Get me set up. Okay, markets. Okay, so we're looking at the ETFs that are doing good today and bad today. The good ones, healthcare. Okay, so these are all the conservative sectors that have done good until now. The ones, whenever there's a rising rate environment, we're changing our game plan. And last week it was, we had a rising rates environment that was bad for tech, bad for growth, good for dividend, and all of those, it's flipping today, basically. It's flipping because of that interest rates. Now, the healthcare is not doing so good. Conservative utilities, staples, these are all sectors that were doing good until this time. And now the ones that are doing the best, oil, energy, semiconductor, tech, U.S. energy, okay, technologies, okay. So it's basically flipped with that report that came out on Thursday, and the election. So possibly the reason oil is up, if the Republicans win, they're heavy oil promoters in business, favor companies. So they're going to allow for more drilling in America, perhaps, and maybe that's why the energy companies in America are going up. All right. So, and the home builders are up too today. So it's all an interest rate situation, it seems. Let's look at the market. Let me see. Okay, a lot of these have in common China reopening. That story about China reducing the quarantine day to 2 days, they were relaxing their COVID restrictions. That's really good for Wynn Resorts and for Nike, because Nike has big sales and growth in China. Las Vegas Sands, perhaps. I don't know if they have China territory, but I think I'm surprised China companies are known. Let's look at the ones going down the most. Cigna has been a very good performer to date. Eli Lilly, okay. So we're basically, whatever worked so far this year as the top performing stocks, it's basically flipping today. The healthcare, that have been doing good. The defense, Hershey, these are all conservative stocks that have paid dividends and did well until this year. And they're not doing good today. Okay, so there's like a rotation going on. Let's look at the NASDAQ. Oh, DocuSign. Okay, people are going into the high PE stocks. This could also be the short covering we've been talking about. Stocks that, that didn't have the earnings to match their statistics. And that could be like a short covering rally. All of them are high PE ratios. The antivirus companies, Zscaler, CrowdStrike. Okay, so it seems like there is a flip to risk on today. And these are all stocks, the top decliners. These are all ones that have done the best year to date. We know Pepsi has been an uptrend, T-Mobile, and they're all actually starting to go down. All right, so it could have been that meeting on Thursday where they said the CPI number, that could have basically flipped everything. Let's look at the Dow, Nike, Walgreens, Dow, Walt Disney. Disney was down 13% on bad earnings. Okay, I think we're approaching like a fear of missing out on a lot of the very strong stocks. We've been talking about Nike and Google and Microsoft, Apple. It's stocks that are basically thrown aside. When the stock market goes down and we're in a downtrend, every stock goes down regardless, of the quality of the stock, because they're all part of indexes. So now there's fund managers playing catch up. There are I think the biggest all the big tech stocks are going up today. Let's look at okay. All right, I don't see anything in there that we're talking about. Okay, now let's look at next talking point. Okay, so today we're right at a crossroads in the stock market. So if we can break out of this and keep going up next week and into Thanksgiving, that could be our signal that we'll have a rally for the end of the year. We have a greed in the Fair Greed Index. So we have a lot of cash on the sidelines now. The people they sold out at the lows, and now there's a fear of missing out. And they're piling in, and people normally pile into quality stocks. Stocks like Microsoft, Google, Apple, that are down 30%, and that's one of the first things people go to. But ones going up the most likely are the ones shorted the most because of short covering rallies. And VIX is down too. Let's look at the VIX. The VIX is it's 23, so that's like a very normal, stock market complacency level. It's not a fear. When it gets down to 10 to 20, that is the time when people are in bull mode and stock market goes up and people aren't afraid. All right, so what's the big news of this week? We had Republicans seemingly ahead in both House and the Senate. We have some runoffs, we have some uncounted votes, and that might take a while. And this uncertainty is, causing the stock market to kind of pause. But if we have Republicans win both, that is business friendly. And if there's a half and half and there's a stalemate and no laws are passed, that's also good for stock market because there's no change to business models. All right. So let me see. Hold on for a second. I'm going to do one thing. Okay. All right. Okay, so CPI came out on Thursday. This was the big news of the week, the reason the stock market is rallying. It says we're seeing a slowing growth in consumer price inflation. So that's one of the major things that the Fed looks at. And they look at the part of the CPI is rents, and rents are actually they're stubbornly high, but the price of automobiles and other major things are going down. Okay. All this being said, let's look at this downward trend. We are still in a bear market. Carl Icahn, he's a pretty savvy investor. He does a lot of investing in companies that are. He fights on boards, tries to get businesses to change. He says big bear market rallies occur because of large short interest built up in the downturn, and inflation shows some sign of easing. He says wage increases, price pressures are are stickier than most think because of wage increases. He says it's going to take a while before inflation works its way back to a 2%. He says it's not going away. He was around in the 70s, and it took years and years to get it over with. So he thinks inflation is going to stick around for a while, and it's going to be around for a long time. So he's putting the caution that we still might have a problem. But on the opposite side, we have someone, Jeremy Siegel. He said inflation is basically over. And the CPI report said lower than expected inflation. He expects a year-end rally, and he said there's a chance we can avoid a hard landing. He says he recommends investors own both value and growth in a balanced portfolio. So so he says that the current price data shows an ongoing decline in both home and rent prices. He's been on CNBC like every day for the past month, and he's been consistently saying that inflation's going down. What are they doing, raising rates? And now this report basically is what he points to and says, we don't have a problem with this anymore. So you always look at two sides of a problem. Okay, we were talking about this earlier. The crypto exchange, FTX, files for bankruptcy. And there's a possible $8 billion hole to be determined. And we don't know who lost in this. There's a lot of leverage and a lot of bad practices at this company. And just a reminder, we had a problem with long-term capital management in 2008, and they only had a $3.6 billion issue, and that was like a spark for the financial crisis, for a certain crisis back then. So there was a liquidity. The fund was liquidated and dissolved. We don't know what's going to happen here. I think Matthew was saying about how maybe all cryptocurrencies were going down because of this, maybe a lack of in these companies that are managing the cryptocurrencies. But there are red flags everywhere. I mean, Warren Buffett says he wouldn't buy all the Bitcoin in the world for $5. So I trust Warren Buffett on this one. It seems like a Ponzi scheme, and eventually these coins will trend towards zero. I don't know. Any comments, Matthew?
I was going to say that I think that there's a lot of risk right now. And this exchange, this FTX exchange, was also it had been a lender of last resort to some other crypto businesses earlier this year, and the biggest exchange, Binance, said that they might rescue FTX, but then they got to look at the books and said no, we can't do that. This is a insolvent business. So I think there's going to be a lot of other companies that are going to get caught out, and we're going to find a lot of crypto companies that are not well capitalized. They've been doing risky things, and as these prices drop, they're getting wiped out.
Right. So I guess a lesson learned: if you're into this stuff, don't put all your eggs in the one exchange. If there's a sign of problems, take your money out and put it somewhere else.
Yeah, I think FTX also had investments from some venture capital firms like Sequoia. There were some kind of big names that are losing money there. Yeah. So I think
I heard they wrote they had their Canadian pension fund lost everything and lost a good portion, of their fund to this, and then Sequoia they marked everything down to zero, their investment. Yes, and a lot of celebrities were involved with this too, in hyping this, like Tom Brady, and so I don't know that there might be some lawsuits against the celebrities that hyped the FTX platform. Who knows? But the bottom line for all this, it's not an investment. It's risky, and in general, crypto coins are only worth what the next fool is willing to pay for them. And whenever everything starts falling down, it'll eventually we'll find out. There's a lot of leverage in this too. People are borrowing money to buy Bitcoin, and if there's margin calls that are cascading, it might eventually go down to a very small portion of what you paid for it. I don't know, but there's a possibility of, I mention this every week, a possibility of a black swan. If there was maybe a major company like MicroStrategies that had some money and they lost $8 billion, they could go insolvent. I don't know. So you have to keep in mind these possible black swan situations, kind of steer clear of anything that might be involved with that. All right. Okay, so I got some interesting news. Waymo, this is a subsidiary of Alphabet. They're making self-driving cars. They're starting a full-fledged robo-taxi services in Phoenix. We know from our talk last week that CFRA expects income from this venture in 2026. So it's going to be a while. They're still testing. The great thing about Google is they do things perfect. They don't put out software that doesn't work usually, and they always test things really good before they deploy them. And we know Ford, one of the four competitors in this space, they said they're not going to pursue this anymore. So they have a pretty big market. I was looking at the global ride-hailing and taxi market. If they take a portion of that, that is valued at around $200 billion. So if they get a portion of that and they have self-driving taxis and it becomes a standard, that could be maybe in 2026 a portion of Google's income. And let's see, so it's growing at 11% too. So that ride-hailing market, they might, maybe a company like Lyft or Uber might license their technology. Let me see. The other part of this business, not only they have ride-hailing, and they have software they can sell for car manufacturers. So Ford, we know, is not doing this in-house anymore. They're going to need some software to put in their computer, in their cars, to be maybe safer anyways. So let me see. The future profits of this is not baked into current estimates because Google's not going to allow cars to be self-driving until they're ready. Versus Tesla, which people are getting in the wrecks around the country, and there's problems with that technology. So that's what I like about Google. They're always forward-thinking, and they do their testing and make things perfect before they make it into a product. All right.
It's interesting, Phoenix here. I think that there's some advantages to doing it there. I think there are a lot of nice, wide, well-marked roads and no bad weather.
Oh, absolutely.
About, snow on the roads and things.
I used to live in Phoenix. The great thing about Phoenix is the roads are flat. There's not a whole lot of hills, and of course, with being a desert, you have complete visibility most of the time. There's maybe a rain once a year. And the other thing is, the street signs are like the best street signs I've ever seen. I mean, they're super clear, and it's a good environment because of those reasons. And most of the roads are up and down and sideways. They're not like in Boston, you have like circles for roads and, curves, and makes it a little bit more, allows software to be implemented a little better.
Yeah, and the other thing with the robo taxis, I've seen some people think that people will like own a fully self-driving car. I'm like, well, if there's a bunch of fully self-driving cars and you don't need to own one, you can just pay a subscription fee and have it come and pick you up.
Right.
Because you can have an expensive vehicle with fancy sensors. You can have a much more expensive vehicle if it's being used like a taxi service rather than everyone like owning their own fully self-driving car.
Right, and that was a portion of Elon Musk's vision, where he has a really good self-driving software for cars. Then he allowed people to lend out their Teslas for other people to use while they're not using it that day. So that would be a really good business model if they had that perfect. Right now, there's too many bugs with their software, I think.
But I think that's also like Uber's idea, right? Is that eventually Uber would just like own a fleet of self-driving cars rather than paying people to drive around.
Right. Well, that's where Google could make some money if Google ended up being the standard and the most reliable without any problems in the industry. Maybe they would license their software for their fleet. So another company that could benefit from this is a company like Avis. We see Avis right now as a car rental company. People aren't renting cars anymore, but they're signing deals with Waymo where they're servicing their fleet. So they're going to store their vehicles at Avis parking lots and service their cars as a fee. So that they could benefit from this too. So you have to think of the downline of all the people, all the companies involved in this kind of future product. So let me see. Future, okay. Right, so it's not going to be profitable for a while. They do things it takes them a while to get things perfect before they put it across America, maybe. We already talked about this, about, how if you see an undervalued sector, we saw the home builders is down 30-40%, yet at the time there was a high demand for houses, but mortgage rates were going up. And this is probably a short covering rally with this 14% up for every one of these home builders. But our idea a couple months ago was to buy a little bit at a time, knowing at the end of next year, maybe the government or the Fed will start reducing the interest rates, and that'll make it more affordable. Then there'll be a housing boom starting then, perhaps. But right now, if you didn't get into it, back 15-20% ago, it's a little bit too late. That's why it's important. If you're interested in a sector and if the thesis of there's still a demand shortage of houses, but right now people are moving towards renting, just driving up rental rates. Can't afford the homes, then that's like the little trade-off with this interest rates. But probably in a year or so, these home builders will recover with interest rates going back down. But we'll keep our eye on this sector just because we started. And okay, so right now we always look at this emotional chart. It's very important. Right now everyone's greedy. So we're either here, people have this enthusiasm, greed, probably right here. And we know in our stochastics, you can see that we're in a downward trend. We're trying to break out today at this absolute penny. We're at the top of this channel. Probably today or tomorrow, if we break out some more, that could be a signal we'll go out more. But let's look at so right now, people are greedy, people are fearing, missing out. You just have to throw away all these emotions when you're investing. Look at the numbers, like how we've been doing with the tech stocks. People, there's consistent demand over time. You have to look at their performance over time, their PE over time, and if they get undervalued, you don't have a whole lot of that in your part of the portfolio you're trying to build up, then you buy a little bit, just a little bit at a time. And if the market corrects, then you have to be willing to buy a little bit, and you can't get super upset and let the price of the stock control your emotions. So we always like to do that little exercise. We know the last 2 months of the year are usually good. And we have, I think I wrote something about the midterm cycle. The week of the election for midterms, the stock market is on average up 8.8%, and for the next year it's usually up. So there's a very good historical precedence right now for the stock market to go up. Maybe it's because in election years, people are getting used to a new role and they don't pass a whole lot of less legislation, and that's good for the market. Not sure, but it's looking like the Republicans might have more power than they did last time, and that could be good for businesses. All right. Is there any stocks that anyone wanted to go over? Or okay. We were looking at this note from the Twitter guy last week. It's a pretty rough day for the tech giants. Feels like just a matter of time before rotation action starts working in their favor rather than against them. And this guy was spot on. This was last week, right at this time. We had every one of the top tech stocks dropping. And people were, in the scheme of things, they were down here. They were in despair. And It's just, you have to think like a contrarian, whenever everyone is selling something, you have to like say, well, this business model still valid, and do we see an end of the tunnel with this? So for me, I'm keeping an eye on the 2, 3, 4 year growth rate estimates by these analysts, and at least it's going up for the stocks we're watching. Let me see. All right. Okay. Let's look at the most shorted stocks and see if we have any potential stocks that might have a addressable market, total addressable market. Beyond meat, I don't know. I think it could be considered a fad, this vegetarian thing. MicroStrategy, they bet huge on Bitcoin and borrowed money to buy Bitcoin, and Bitcoin's going down. That's not a good business model. Nikola, no, they're not a good one. Let me see. We have a lot of electric vehicle manufacturers in this. Faraday Future, we have Nikola, we have Lucid Group. Okay, Lucid Group here, they're down 23%. All right, so Wayfair is down. They make furniture for houses. Maybe they sell furniture for houses, retail or department stores. Blink Charging, they're a company that does charging for electrical vehicle networks. They're down. Their short interest is 30% still, and they're down a good portion this year. That could have a large total addressable market if their technology is used, like gas stations use the pump. Maybe if their technology is implemented across America, that could be a huge total addressable market, and that could be a form of residual income for them. But they're not making money right now. So there's only three or four vehicle charging stocks, and most of them are in the list of heavily shorted companies. But right now, those stocks would go up because of short covering. That was good exercise. Now, let's go to finance, Yahoo Finance, just for kicks for the last little bit. See what's going on. Okay, it's turning into a pretty good day in the stock market. Looks like we could be breaking out. Let's look at the S&P. It's going up to 4,000. We were talking about the 4,000 as the top of the range. Let's look. Okay. Okay, let's look at where we're at right now. We draw our highs and lows. Get this. This is all I do when I make these charts. I go like that. Highs. Okay. So we're almost at this top of this downtrend. If we can make some right now, lead us out of here. All the tech stocks, all the big tech stocks will probably take us out and lead the way because they led the way down. We can see the FANG stocks are all participating today. Let's look out a couple months just to see where this can go. And let's look at, okay, so we have resistance right here, 426. We have resistance at 455, and we have resistance at 477. Let's look at the S&P. Okay, so seems like we're switching right now from, what worked up until this year until worst into this year. Hold on for a second. Okay. What I'm doing right now is I'm pulling up some of our meeting notes from last year. Okay, move out of higher valuation stocks to ones with lower value. This is Christmas of last year. Example, out of tech into banks, drug stocks, phone companies, PEs that are lower. Okay, we had a rally. Biotech, drug stocks were poor performers in 2022, may outperform the next year. Drug stocks have low PEs and low valuations. Okay, so that was our plan for last year. Now what we're doing is we're flipping this. As you can see from the top performers today, people are going to rotate out of the conservative stocks, drug stocks that were the best performers in 2022, and they're going to rotate into the ones that performed the worst, which are the tech stocks. So we're kind of flipping things around, but right now, I think that's what's going to be happening. So we like to do this every year just to say it's a reversion to the mean exercise. And so we also have to look at what's the fair PE value. If the Treasury is under 2%, the PE value is higher. And right now we have the Treasury at 5. The PE that's acceptable is like 12. So we're going to do this exercise again next week. We're going to look at the best performers and the worst performers, and we'll make a prediction for next year, what'll do the best. I think the FANG stocks will be, from now until next year at this time, will be better performers than the ones that did well until this year. So that's a good exercise. I think time. Thank you very much for attending. If I can answer any questions for you in a